My name's Tim Hart. I'm the Director of Private Mortgages Australia, and this is our last webinar for 2016. What a great year it's been, and what I really want to talk about today is just to give you a bit of an insight into what is private lending, how does it work and when to use it, and also when not to use it, and just some of the tips and tricks that we can give you to help your clients. And some of that's just looking at the rates, the charges, but also what's a coded loan and what's a non-coded loan, and when is it good to use private lending and when is it not good. So let's get straight into it now. I'm going to go for probably about half an hour, and we're happy to provide the recording to you, but there will be a bit of question time at the end as well. So you'll see in your dashboard there's actually a little text box you can put in your questions, so just please type them in. We love it when you guys interact with us. We really want to hear what you guys have to say and any questions you have, because ultimately this is for you guys to get the most out of it, and hopefully, we can help some of your clients. So first thing, let's get straight into it. The first thing you'll see is with our products is that we do business finance. So we only do business finance. We don't do any coded loans. So if mum and dad want to go on holiday or buy a car, it's not something that we do. So it's more of for a business purpose. So we've got three products: first mortgages, second mortgages, and caveats. You'll see our interest rates there. We quote PCM, which is per calendar month. So don't get too excited, it's not per annum. So for us, our average loan is around about 4 months. So it's real short-term funding that we specialise in. We do anything usually from 2 months to 12 months, and our first mortgages minimum $50,000, and we cap out at around $2 million. Just on that, we can actually look at applications above $2 million, but it's sometimes it'll be funded externally. So we just obviously want to make sure that everyone's aware of that. But definitely $2 million and under, it was all done in-house. So we do first mortgages, second mortgages, and also caveats, because it's not always possible to get a mortgage registered on a property. So in those circumstances, and usually when someone needs to settle really, really quickly, like in a couple of days, that's when we'll use a caveat, and that's why the rates are a little bit higher on those on that product. Okay, the other one, a common question we get asked is, how much are you going to lend? And these are our loan-to-value ratios. The way we actually break it up is in postcode categories. So you've got category 1 through to 4. So that's based on the Genworth financial postcode categories. So if you're not familiar with them, category 1 is your your CBD and in the suburbs. So usually about 40 to 50 k's around a major, you met Melbourne, Sydney, Brisbane, is usually category 1. A little bit further out, usually your major regional centres start getting into that category 2 location. Smaller regional centres, category 3, and category 4 is just think whoop whoop. In the middle of nowhere, we still lend there, but obviously we'll lend a lot less there. Now, one of the things you'll notice is that we've actually got a maximum. So for category 1, residential, we might do 75% is what we'll lend up to, but we've actually got discretion to lend up to 80%. Now, what it comes down to is typically how good is the exit strategy, how good is the repayment strategy of the client allows us to lend more. With private lending, it's all about being flexible. Okay, the last thing we want to do is be like a bank that's got a little box, and if you don't fit in it, then we're not going to lend to you. For us, it's more about how can we make this work? How can we make this work for your client to be a win-win for both parties? At the end of the day, it has to be a commercial, but it's all about that flexibility. So let's talk about the fees and charges, usually what people want to hear about when it comes to short-term lending. There's definitely some firms out there that charge a lot when it comes to the fees and charges, and so for us, we like to keep it really simple and really affordable. So for us, these are the only fees and charges that we'll have, other than obviously the interest. So we've got a small upfront assessment fee. So this is usually between $550 and $770, and it's just based on the complexity of the transaction. So most of our deals are in that $550 to $660 sort of mark. But that really just covers our cost to do all the searches and have the initial assessment on the transaction to produce the indicative letter of offer for your client. If evaluation is required, and it's not always required, we always do it at cost. Also, any legal fees are at cost. Okay, so we never make any money on valuations or legal fees. For us, we like to make our money by lending money, not by just charging valuation fees and all that sort of thing. So the only fee that we have in there is the approval fee, that when the loan is approved and we go to settle the loan, that's when the client will need to pay the approval fee. So for less than $100,000, it's just a flat $3,000 fee, and then obviously as a percentage it goes down from there. So the more they borrow, obviously the cheaper it is for them as a percentage of the loan. Now for us, that's what we get from PMA. We also like to work exclusively with referrers. So the way we work with referrers and the way our referrers get paid is that you can either mandate your client directly, and if you don't have a mandate, you can actually go to our website, privatemortgagesaustralia.com.au, and we have a resources section there. You can download a sample mandate if that's the way you would like to get reimbursed. Alternatively, you can add to our approval fee. So our approval fee might be 2%, and you might say, great, just put me in there for 1%. Okay, so when we submit the offer to the client, the approval fee will be 3%, and we note that 1% will be going to yourself. So it's all disclosed, but it makes sure that you get paid for the transaction. The other thing that we do that I'm not aware of anyone else in the marketplace that does it is a 20% future deal bonus. Now what that means is if you refer a client to us and they ever come back to us directly, we'll actually pay you 20% of the approval fee. So even though if you do nothing, you never hear from the client ever again, but they come back to us directly, you'll get 20% of the approval fee. Now if your client comes back to you and then you put the deal through us again, by all means, you can mandate them, you can add to the approval fee, just like a normal loan. But it's just those scenarios where sometimes a client will come back direct. Because you can imagine if you refer a home loan to, say, the Commonwealth Bank, if that client then goes back and gets a car loan or something else from the Commonwealth Bank, then they're not going to pay you anything. And for us, we don't think that's fair. We like to give you a bit of ownership around that client and make sure that you're referred, so that you're paid for those deals that come in the future down the track. The last thing we've got is it's a new program we're running now is Referral Rewards program. So this is what it looks like here. This is the table. So the more you refer deals to us, the more that you'll get. So for the first $1 million of loans that you refer, you'll get a $250 gift card. Now we've got in there Maya, Dan Murphy's Flight Centre. It's up to you what venue you'd like it for, but we've just got a few ideas there for you. Then it goes up, so $2.5 million, you'll get another gift card for $500, and it goes all up to $10 million, you'll get a $2,500 gift card. Plus, you also get lifetime access into what we've called the PMA's Platinum Playground, and so you're one of our Platinum referrers, and you'll receive a $500 gift card every financial year, provided you refer at least $1 million of loans to us. So that's just how we reward our referrers, because ultimately that's where our business comes from. So we want to make sure you guys are looked after. So let's just get into understanding short-term lending and how it actually works. So the process for us is that you'd submit an application form or our quick app form, and our quick app form is just a one-pager. So you'll submit one of those, and we do some initial assessment on it, and we see is the deal a go or not, and we give you a bit of an indication of what sort of rate it's going to be and what the assessment fee will be. So we'll come back to you with an indicative letter of offer that has all the details of the loan and the fee that needs to get paid. If your client decides not to proceed at that point, then it costs them nothing. If they decide to proceed, they'll need to pay the assessment fee, so the $550 to $770, and that's when we do the remainder of our due diligence, so just double checking that everything that's been disclosed in the application form is all true and correct, and then we proceed to the formal letter of offer. As soon as the letter of offer is signed, it's usually a number of days, and then the settlement occurs. So usually it's just legal documentation that goes to their solicitors, and we settle shortly after. So it's a really, really quick process, and for us it's all about streamlining it. So we've actually got our own software that we've developed to help make sure all our applications go through as quick as possible, because for us, we understand that if you're bringing a client to us with short-term lending, usually it's because they need the funding quickly, and that's what we're providing as a service. It's not just the money, it's also the speed in which we provide the funding for your client. So let's look at qualifying a deal, because this is probably the biggest one, is we're not too sure if we've got a deal, Tim, or we don't have a deal. And so what we like to share with our referrers is what we look at when we're qualifying the deal. And this is what we call our first filter. So first cab off the ranks is the loan non-coded? So we only do business lending, so it can't be, you know, as I said before, mum and dad doing, you know, going on holiday. So I just want to really drill down on that, because there seems to be a lot of confusion around what is a coded loan and what is a non-coded loan. So just to clear things up, first thing to look at is who is the borrower. So if your client is has a company, so that and the person that's actually, or the entity that's actually borrowing the funds is a corporate borrower, like a company, then it's automatically non-coded. Okay, it doesn't matter what the security, doesn't matter if it's residential property or anything like that. As long as it's a company that's borrowing the funds, it's non-coded. Okay, so that's nice and simple. If we then have an individual borrower and it's for domestic purposes, then it's coded and we can't do the loan. However, if it's an individual borrower and it's a business purpose, so that person might be buying a business, buying shares in a business, or something where it's an actual business purpose, then that's then non-coded and we can do that loan. The other one we look at is the type of security. So if the security that the borrower is putting up is commercial property, then it's non-coded because it's a commercial property. If it's residential property, we still can lend on residential property, but the purpose of the loan must be for business purposes. Okay, so there's the real distinctions that we look at. If you've got a specific loan scenario you want to run past that's a little bit curly, by all means, please send us through a scenario and talk to Peter Cuskelly, our credit manager, and we've got his details at the end of this presentation. So let's get back to the first filter. So provided the loan is non-coded, we then move to whether or not the borrower is happy to pay at least 1% per month. Okay, because if they're not prepared to pay at least 1% a month, that's the cheapest rate we'll ever do. So if they're expecting to go and get, you know, 6% or something like the bank, then we may as well stop there, because it's never going to come in at that rate. So we just want to make sure that the client's expectations are where they need to be. The other one we look at is the postcode and LVR, or loan to value ratio. So before I showed you that table that showed whether or not how much we'll lend in a particular location. So we just want to make sure that they're not trying to get an 80% loan in the middle of whoop whoop. Okay, so just that it sort of made sense. The next one, how much you as the referrer want to make. So how much do you want to make? So we just want to make sure that's noted on the loan before we send out any loan documentation. The other big one, and probably one of the most important ones actually, is the exit strategy. So this is actually the repayment strategy. We're going to lend someone some money. We want to know how they're going to pay it back. But one of the key differences with us and with private lending through Private Mortgages Australia is that serviceability is not required. Okay, so we don't really care how much they earn per year or their serviceability, because with us it's not designed to be a loan that gets serviced. It's, you want the loan for 4 months, great, you get the money, 4 months later you pay the money back. It's not designed to be serviced. So for us it's all about how are they going to actually pay it back? Are they going to refinance the loan? Are they going to sell the property? Are they going to sell a business? Have they got some money coming in from an estate? I don't know, whatever the scenario is. That's for us. We need to really understand how they're going to pay it back, because the last thing we want is to put a client into a loan where they've got no chance of actually paying it back, or no strategy to actually repay it. Another big one is, why can't the client get bank finance? Okay, because if the client can get bank finance, don't come to us. It's as simple as that. We're going to be a lot more expensive than a bank. So just we want to know why the client can't get a bank loan. Now, it just could be as simple as the bank is going to take 4 to 6 to 8 weeks to get the loan done, whereas we need it done in 1 week or 2 weeks. Okay, and that's why they're coming to us. That's quite a common reason, is the speed in which they need the funding as to why they can't get the bank funding. The other one is, when does the client need to settle? Okay, so we want to make sure that we're all working towards the same goal, that we don't have a client that says, great, here's my loan application, I need the money this afternoon. Okay, it's not going to happen. We need to make sure that we've set the expectations that, great, you need to settle in 2 weeks' time, or whatever date it is, that we're all working towards the goal, so that it's going to be a loan that's actually going to proceed. So let's look at a bit of an example. This is a deal we did earlier this year. So the scenario was it's a borrower. They bought a development site in Altona North in Melbourne to do a 3 townhouse development. The build was 90% complete and then they ran out of money. So they were trying to self-fund the development and then they just basically ran out of money at the end of the transaction. The borrower was a company. The borrowers had no experience. This was their first development deal, which for a lot of banks is a big no-no. They don't really like that. For us, it's not as much of an issue. Serviceability, they were self-employed and they had no financials. So once again, a big no-no for the banks. The valuation came in at 1.95 as if complete. So once they'd finished constructing the 3 townhouses, that was the value of the site. They already had an existing first mortgage of $520,000. They had a building contract of $650,000 and they'd already self-funded $250,000 of the build. Okay, so they had a shortfall of $400,000 is what they needed to be able to complete the construction. And they only needed the money for 2 months. Okay, so they were just there and they just needed that money just to get them over the line. And their exit strategy is they already had sold 2 of the townhouses. So let's look at how we actually qualified this loan. So we looked and said, is it non-coded? Yes, it's a company borrower, great, nothing else to look at, it's non-coded. Is the client happy to accept more than 1% per month? Yes, the borrower was happy to pay 1.9% per month. The postcode was category 1, so if anyone from Melbourne, if you know Altona North, great spot. You know, we're talking 5-10 k's from the city, and the loan to value ratio is less than 65%, so it fit within our loan to value ratio for development. How much did the referrer want to make? They wanted to make 0.6% plus GST of the loan amount. The exit strategy was the sale of the units. Why couldn't the client get bank finance? They were self-employed, they had no financials, no experience, and they needed the money like yesterday. They needed money as soon as possible, really. And the first mortgagee wasn't prepared to extend them any more money, and they didn't want to wait the long period of time that a traditional bank would take to get the funding. When they needed the funding as soon as possible, they actually had an outstanding invoice to the builder for $330,000. So they needed the money as soon as possible. And as you can imagine, the builder wasn't too happy. You know, they'd done the work and they wanted to get paid. So they want to make sure they got paid for the work they'd completed. So the solution was we provided a $435,000 second mortgage. Okay, so that made sure that they got the $400,000 they needed. Plus we made sure that their interest payments were covered for the first 2 months and all their approval fee was covered. So that made sure that they got the $400,000 cash in their hand that they needed. The interest rate was just 1.9% per month for the 2 months. With all our loans, we'll typically give a 6-month worth of extension periods. So a lot of clients say, yeah, look, we only need the money for 2 months, but things go wrong in the real world and delays happen. So we always like to give a bit of a buffer that a client can just come in, they make 1 month's worth of payment, interest payment, and we'll extend the loan for another month for them. So we just give them a bit of breathing space there. The approval fee was 2.6%, of which 0.6 went to our referrer. So that was a great transaction and a great deal for the client as well, and enabled them to sell the property off and make a great profit. Now, for us, when we look at trying to understand short-term lending, and for us, the biggest mistake we see most borrowers make is they focus on the interest rate. And for us, the interest rate's almost irrelevant. The more important thing to look at is the total cost of the loan, which obviously includes the interest, but it also looks at what the approval fee is. Because you might have another lender that might say, oh, look, we'll do it for 1.5% per month, but they might go and charge a $30,000 approval fee and $10,000 for legal admins, which makes it a lot more expensive, even though their interest rate was a little bit lower. So for me, the only way to assess a short-term loan lending opportunity is to look at that total cost. So for this one, the interest was going to cost them $16,530 for the 2 months. The approval fee was $12,441, and the legal admin fee was $5,500. So the total cost of this loan, let's call it, just under $35,000. Now, the only question for the client is, is it worth $35,000 for me to get this money? Okay, does it make commercial sense for them to spend that money to be able to complete this transaction? So this is what, for me, what a lot of the clients would look at. For them, the value of the site, once it's all finished, the gross realization value was 1.95 million. Their cost, $650, stamp duty would have been about $35,000, their total cost $650, and I've put, just roughly, I put in there other costs for real estate agent fees and council fees and holding costs of about 115 grand. So all up, from this transaction, they're going to make about $500,000. So for me, it's a question of, does it make business sense to give away 7% of your profit, which is about 35 grand, to get the deal done? And obviously for me, that's a pretty easy question. Do I spend 35 grand to make $500,000? Very, very easy. So if you look at lending, you know, for this client, if they were going to spend 35 grand to only make $30,000 profit, then it wouldn't make sense. So it's a really quick and easy way for a client to see, should we take on this loan or not? So just to give you a few ideas of what the other types of lending that we do, the main one we do specialise in is urgent funding. So someone needs money quicker than a bank can possibly give it to them. The other one, asset lending, so where we don't really care about serviceability, it's all about the asset for us, okay? What is the value of the asset and how much can we lend against that? Another one we've done a fair bit of, ATO debts, where the ATO won't provide any payment plans anymore, and you know that you sort of get the, you need to pay this bill or we're going to wind your company up, and the client just can't afford that. Another one we get is refinancing existing caveat loans. So there's some caveat lenders out there who charge phenomenal interest rates, especially when they go into default. So sometimes we might come in and refinance a loan that's, you know, they might be paying 10% plus per month, and we can come in and get them a much better rate while they sort out their exit strategy. Another one that we do that you know, no bank will do that I know of is we'll actually lend on the valuation not contract. So if the value of the property is worth more than they bought it for, we'll actually lend on the valuation. And that's something we've done. We've actually lent on one of the deals, we did 102% LVR. Okay, but it was only a 70% of what they the valuation came in at, but they just bought it for a great price. Okay, so we live in the real world. We understand that you can buy property under market value, but obviously the valuation does need to stack up. Other scenarios we've had, people paying out business partners, they get an urgent business opportunity they want to take advantage of. We also do a lot of stuff with developers, especially around completion finance. Okay, so they run into a bit of trouble, or maybe they hit rock or something happens and they just need a bit of short-term fund to complete the project. The other one we look at is impaired credit. Okay, so we're not too concerned about the credit of your applicant. We're more interested in their exit strategy. Okay, just want to talk about a few things to be wary of, I suppose, of other lenders and what they're doing in the marketplace. Now, before I get into this, I do want to say, I know there's a few people that have trickled in since we started. If anyone's got any questions, please, there's a little text box in your little console there. Please send through any questions. We're going to get through questions in just a moment. But yeah, we'd love to hear from you, what you like, what you don't like, anything you want clarified, please send it through. So let's have a look at some of the things other private lenders do. So what we see a bit of in the marketplace is these from rates. Okay, so where they say, hey, we do loans from 1%. Okay, where they have no upper edge. Okay, so from one, they could come back with an offer of 10%, 6% per month. But they use those from rates basically to lure people in, thinking, oh, great, I'm going to get 1% a month. Rather than giving them a bit of a range so they know where it could actually, the interest rate for the loan will be. Another thing we see, which is really unfortunate for the industry that we see, is really big upfront fees before the final offer. So I saw one the other day, it was an $18,000 fee, upfront fee, that the client had to pay before they even got the final offer from the borrower. Okay, so before they even knew what the final interest rate was and whether or not they were going to do the deal, they had to spend $18,000, and that's a joke. Like that's actually happening in the marketplace. For us, We like to make our money by lending money, not by charging big upfront fees and then never doing the actual transaction. Another thing we see a little bit of is these 24-hour loans. A lot of the time what we see is that it's very hard to actually do a 24-hour loan. There's a lot of work that goes into it, and basically there's a lot of people that will get the client in by thinking, hey, we can get this loan in 24 hours, when what will actually happen is at the end of that 24 hours, they go, hey, we need a bit more time, and then it's another 24 hours, and then another 24 hours. And they know that once they've got the client in the system, it's very hard for them to go to somewhere else because they don't want to start again with another lender. So just be very careful. I would always ask someone who's saying they do 24-hour loans, ask how many 24-hour loans have they actually done. You know, it would be usually a very, very short period number that they've actually done. Now we've just had, someone's just come through. Is anyone else having an issue with the audio? If anyone just text through. Can you guys hear me okay out there? I know maybe we just had a bit of a blip. Someone could just text through. Can you guys hear me okay? Yes, okay, great. Yeah, if you do have issues, please let me know. Okay, seems to come in and out a little bit. All right, look, I'll keep going. I said we'll provide the recording so you can listen to it, and obviously any questions you have, we're more than happy to have a chat to you a bit more about it. The other thing we've got is we see is very expensive valuations. So one, the borrower, sorry, the lender is making a profit on the valuation, which we think is ridiculous. But they also do the valuation for forced sale. So rather than doing one for mortgage purposes or for market value, they do it for forced sale. So obviously you can imagine the valuation never quite comes in where it was meant to come in. And this is usually where they'll have a very expensive valuation. The valuation will come in really low and the lender will say, sorry, we can't do the loan because, you know, the valuation didn't stack up, but thanks for all the money that we made on the valuation, see you later. Okay, we see it all the time. So just be very, very careful of that and look at what type of valuation that they're doing. The last one we see here is cancellation fees, usually a percentage of the loan. So where they will sign you up on an offer and the offer has charging clauses, and if your client decides to walk away, then they still have to pay a cancellation fee, even though the loan never proceeded. And what you'll find is that they'll put a caveat on the property, and they'll put a PPSR charge, a personal property security register charge against the borrower, and essentially they hold the person's property to ransom until they get their fee. Now, for me, if they've issued the final letter of offer and it's all ready to go, and then they sign a charging clause, okay, that's fine. But I don't like to see cancellation fees when it's just an indicative letter of offer and you don't even know what the final outcome is going to be. We just see that all the time where they're basically just in the business of charging cancellation fees and they never actually lend any funding. So for us and what PMA does, Private Mortgages Australia, we're all about cleaner loans and better results. Okay, so we do low upfront assessment fees. We have no charging clauses in our indicative letter of offer, and there's no cancellation fees in our indicative letter of offer. Okay, so once your client pays the assessment fee, it might be $550, that's the only thing they're going to pay until they get the final letter of offer. As I said, we may have a valuation in there that needs to get done, which will be done at cost. Any legal fees are done at cost. We also have a capped interest rate range. So our first mortgages are between 1% and 2.5%. Okay, that's it. You know it's going to fall within that sort of that criteria. The other thing we also do is we rebate any unused interest on extension payments. So if your client, they might have a loan for 3 months and then they decide that they need a bit more time because something's happened, you know, the bank, the incoming mortgagee, you know, needs a bit more time, and they need an extra 2 weeks. So they might pay an extension payment for 1 month, but 2 weeks into that, they repay the loan in full. We'll actually rebate the 2 weeks that they didn't use. Okay, just so they're only paying interest for the bit of time that they actually use. So it's just all about being fair. The other one we've got, which I mentioned briefly before, is we've actually got some custom-built software that we've spent just a crazy amount of money on and a lot of time developing, but it's all been worth it because it allows us to do faster processing of deals better than anyone else in the marketplace, and that's really what we like to excel in, is giving that good customer experience, and for a lot of the time it's all about speed. We actually have a high level of repeat customers. That's something we're really proud of. We know if someone's coming back to get another loan, then they've had a good experience with us. They've had a win-win with us. So that's what we really like to see. So we've had people come back and do multiple loans with us. So that's something that is very unique to Private Mortgages Australia. I know there's other private lenders out there in the marketplace that I reckon they've probably never had a repeat client ever again because people deal with them and then they never want to deal with that company ever again because it wasn't a win-win. They got charged a lot of fees and it didn't quite work out for them. So we're all about a win-win approach. If you send us a client, we want to make sure they're going to get looked after. Okay, so and that's ultimately at the end of the day. Our company lives and dies based on our referrers. Okay, so if you don't feel comfortable sending us a client, then you're not going to. So that's why we want to make sure that we always look after your clients when you send them through. Just before we get into the questions, and I appreciate we are running a little late here, is we're giving away 20 iPad Mini 4s are up for grabs. Now, if you do want one, all you need to do is simply refer 2 loans to us by the 31st of December. So we're working right up to Christmas, basically just taking the main days off, and you can get 2 of these if you like. If you refer 4 loans to us, we'll give you 2. If you've already got one, they'll make a great present for someone. But definitely for us, the Christmas rush is definitely the busiest time of year. So please get your application forms in. We'd love to help out some of your clients in the meantime. Guys, we're going to take any questions. I know we've got a couple through here that we'll field. So if anyone's got any questions, please now's the time to ask. If you've got any specific loan scenarios you want to run past us, there's the direct contact for our National Credit Manager, Peter Cuskelly. Either send him an email or give him a call and have a bit of a chat to him. So let's have a look. Can you make the presentation slides available? Absolutely. We'll make that through for you. What I might do, there's a few questions there, but we might answer those afterwards. I'm just conscious that we've gone for about half an hour now. We just wanted to call it here. So guys, look, thank you very much for attending. I hope you got a lot out of it. We'd love to hear some feedback from you. We are actually putting a bit of a survey together to send out to you because we'd love to hear what you liked about the webinar and what else you want to hear about or things you want clarified. And ultimately, we want to help some of your clients. Okay, we want to help them out with their short-term lending needs. So if we don't hear from you, please have a good Christmas break and holiday period. We look forward to doing some business with you in the future. Thanks, guys. Have a good day.